Hello everyone, welcome to the Stock Trading Tutor channel. If you'd like to create a free Demat account with Alice Blue, click the link in the description and fill out your details. And once you've uploaded the required documents, your account will be activated within 24 hours. You'll also get intraday recommendation calls and you can learn robo trading software for free. Now, let's look at discounted cash flows. Now, what is a discounted cash flow? The discounted cash flow is a valuation method used to estimate the value of an investment based on its future cash flows. The DCF analysis finds the present value of expected future cash flows using a discount rate. A present value estimate is then used to evaluate a potential investment. If the value calculated through the discounted cash flow is higher than the current cost of investment, the opportunity should be considered. Now, what are the key components of the DCF? First is the free cash flow, FCF. This is cash generated by the assets of the business, tangible and intangible, available for distribution to all providers of capital. The free cash flow is often referred to as unlevered free cash flow as it represents the cash flow available to all providers of capital and is not affected by the capital structure of the business. Now, another key component is terminal. This value at the end of the free cash flow projection period or the horizon period. Next, let's look at discount rate. This is the rate used to discount projected free cash flows and terminal value to their present values. Now let's look at the importance of the discounted cash flows. It determines the present value of money or asset based on value of money. It estimates the value of an investment based on its future cash flows. It finds the present value of expected future cash flows using a discount rate. Now let's look at the methodology behind the discounted cash flow. It's based on free cash flows and the riskiness of the capital, and the valuation is based on cash flow projections, discount rate, and terminal value. Now let's look at the steps involved in the discounted cash flow analysis. First is the projected unlevered free cash flows. Then you have to choose a discount rate. You have to calculate the terminal value. Then after that, we calculate the enterprise value by discounting the projected unlevered free cash flows and the terminal value to the net present value. Next, we calculate the equity value by subtracting the net debt from the enterprise value. Then we review the results. Now here is the formula for the discounted cash flow. It is calculated as follow. DCF is equal to the cash flow 1 divided by 1 plus discount rate whole to the power of 1 and plus cash flow 2 divided by 1 plus r whole to the power of 2. And this way we keep adding until we have the n number of periods for which we have to discover the discounted cash flow. Now let's look at the pros and cons of using discounted cash flows. The pros include that it represents the intrinsic value, it can make its own projections, and it takes into the time value of money. The cons include that it is highly sensitive to discount rate and terminal growth rate. The discount rate changes over a period of time, so that should also be taken into account or considered before making decisions using the discounted cash flows. Next is the hockey stick tendencies, projection risks. Thank you for watching this video. For more videos on stock market and trading, please subscribe to this channel. If you'd like to create a free Demat account with Alice Blue, click the link in the description and fill out your details. And once you've uploaded the required documents, your account will be activated soon, and you'll also get intraday recommendation calls, and you can learn robo trading software for free.